If you suspect the financial markets are rigged against you, you're looking for the wrong culprit. The entity actively sabotaging your portfolio is the set of psychological flaws hardwired into your own brain. Modern trading is an exercise in structural dominance. The individual investor at home is competing against institutional firms, with server banks physically wired into the exchange, built for execution speeds measured in microseconds. This creates a structural delay. By the time a stock recommendation reaches the front page of a mainstream news site, the window for maximum profit has already closed. Professional funds don't wait for the morning news. They use massive data resources to identify and price in market anomalies before the public even sees the headline. Buying into a mainstream news alert places you at the very back of the line, providing the exit liquidity Wall Street needs to finalize its own profits. Retail traders carry a heavy psychological handicap known as overconfidence bias. It's a documented tendency for individuals to severely overestimate their own predictive abilities. This bias has two concrete consequences. It forces people to trade much too frequently, and it pushes them to take on uncalculated, unhedged risks. Financial media networks are designed to weaponize this bias. They create loud, high-energy narratives that make the viewer feel like they found an exclusive edge, triggering an immediate emotional response to trade. Wall Street's edge is its cold patience. They wait for the retail crowd to commit these predictable emotional errors, and then they profit from the inevitable fallout. You don't need $1 million software subscription to see where the big players are moving their money. The data is actually public record. The Securities and Exchange Commission requires every major fund to be transparent about its market positions. This is a 13F filing. Every quarter, institutions must publicly list their exact stock holdings. Comparing new filings to previous ones reveals quiet capital rotations, exposing massive, stealthy accumulation before it hits mainstream news. Tracking 13Fs lets you ignore the public stories Wall Street tells, and instead follow the actual trades they execute. Beyond tracking capital, you have to understand market physics. A gamma squeeze is a structural event that has nothing to do with company fundamentals or short interest. In delta hedging, when retail buyers flood the market with call options, market makers must buy the underlying stock to balance risk. This creates a feedback loop. Rising prices force market makers to buy more shares, driving prices even higher. Understanding these forced buying mechanics allows you to capitalize on the rigid mathematical rules of the market, rather than hoping for a lucky break. The stock market acts as a relentless machine, quietly transferring wealth from the impatient to the highly informed. To succeed, you must abandon psychological shortcuts, stop following front-page hype, and start analyzing raw structural data like 13Fs and options chains. For more deep dives into the institutional playbook, like this video and follow US Finox. Comment below, which fund's 13F are you tracking this quarter? Stay one step ahead.